All right. So we are recording this for any volunteers who show up or want to watch this later. We'll put it up on the website. Other than that, Bob, you can go ahead and get started. And then as a reminder to everybody, if you can't see the whole screen because people's faces are blocking the screen, in the upper left-hand corner of all the faces, you can click on the single cube and it'll shrink it down to just the active speaker. With that, I'll let Bob get started.
Okay, can you guys see the agenda?
Mm-hmm.
Yeah. Okay.
Yes.
So we're going to cover some process items that we agreed to at our last huddle meeting earlier this week. We're going to go through the CARES Act. That'll be a very short PowerPoint, and I'll do that. Martha will talk about capital gain entries and if there's a carryover loss. Dennis will cover K1s. What happens if we don't get a lot, but if you get one, what do you do? And Dennis will also cover health savings accounts, which are integral. There was not a separate certification for that, so we're all expected to know how to deal with HSAs. Martha's going to talk about if we have can't pay situations, what do you do? And with unemployment checks perhaps being a big part of a lot of returns this year and maybe not enough withholding, we might run into this. The IRA taxable amount not determined and how you do the simplified method. Martha will talk about that. And Medicaid waivers, if we do run across any, and we might. Dennis has done an incredible job with Julia on the Homestead property tax credit housing list. We got the best list ever, the best process, I think. And then Scott's going to talk about city taxes, and we do get some city taxes. We might get more than ever this year. So we can get started. So I have to stop share and then reshare and see if I can find my PowerPoint. And here it is. And then I want to go to slideshow. How do I do slideshow? There it is. Play from start. Can you see that?
Yep.
Okay, so there are three things in the CARES Act that we're going to see. One is adjustments to recovery rebate credits that most of our clients will have received. The second is the earned income tax credit look back. Oh, hey, can we skip to another item because my surgeon's calling me. I have surgery tomorrow for my shoulder. So let's skip down to.
I can do it all, Bob.
Or why don't you do it, Carol? Okay. Never mind. My wife's going to handle it. They're just telling me when I'm supposed to go in tomorrow. I've been planning this for a long time, so it's not anything, not a big deal. Okay. We're going to look at the earned income tax credit look back, where you can take whatever gives you the best result, your 2019 earned income or 2020, and how you avoid the penalty for an early withdrawal from an IRA, which could be COVID related.
Hey, Bob, you need to reshare again.
Okay, hang on a sec. Thank you. And I need to go to my Zoom, and I need to share my screen, and I need to pull up the PowerPoint. And then I need to make it big again. All right, hang on a second here. You guys are seeing the agenda right now, right?
Yeah, top left, play from start.
Yeah, got it.
We're seeing your PowerPoint.
Now you see it?
Mm-hmm. Great, that's perfect.
So the example that I did for all these is a gentleman who had wage income of $5,000 in 2020, and that's down from $16,000 in 2019. In each year, this was his entire earned income. And his income went down because he lost his job due to the COVID-19 pandemic. Due to the financial pressures of the lost income, he took an early withdrawal of $5,000 from his IRA account. He was less than 59 and a half. He also, for the first time, claimed his son, the first time in 2020 by agreement from his divorced wife. So for the first time, he became a dependent on his return in 2020. So of course, his rebates were based on being single in 2019, and that's what we used to look at what changed. So now how do you address the recovery rebate credit? Well, when you go into basic information, you're going to see recovery rebate credit, and you're going to click on that. And when you go in there, it's going to ask you, what did you get? And last year, in the first portion, he got $1,200 because he was single in his 2019 tax return. And then in the second one, he got $600 because they still relied on the 2019 tax return, and that's $600. And so what happens when you get an adjustment, so because he had a child in 2020 that the IRS didn't know about, he should get an extra $500 from round one, and he should get an extra $600 from round two, and $1,100 will show up in line 30 of the tax return because he entered the correct information in TaxSlayer, and it will show up there, and you can just make sure it's there by going to line 30. So it's
And we're just gonna,
not hard to do. You know, you just put it in. You know, the amounts that he got in TaxSlayer will automatically see that he has one extra dependent that he had during 2020 that they didn't know about, and make the adjustment. Go ahead.
so what happened?
Under
I have a
17, right?
question.
Go ahead.
So we're just relying on them to tell us.
That's
what
right.
they
Now,
got.
we're supposed to have a form. TaxSlayer says that they have a form, but I think we can, you know, if they're wrong, the IRS will correct it on the amount that they get refunded, and I assume provide an explanation.
It's not going to necessarily bump them out then. They'll like reject their return if this is wrong.
We don't know, but I don't think so.
Because I can imagine somebody saying, I never got anything, but they got one of those
Well,
pay
it's-
cards and they forget
can
about
o-
it or something.
We can only rely on what they tell us.
Yeah, okay.
You know, but it's the point here is TaxSlayer pretty much takes care of this based on the entries that you put in right here.
Right.
Okay, now the next one. What does the earned income tax credit look back? This is a little snapshot that comes right out of the IRS website, where they said you can take whichever one gives you the best result, your 2019 earned income or 2020.
Are you on your way?
No, I'm not going anywhere if I can't reach you.
So to determine whether it's advantageous, you have to make entries in basic information in the personal information section. And I'll show you what that looks like. But you want to have some idea whether it's going to be any good for him. Now, what you could do is just make the entries and see which one is the best. But there is a really good chart that Julia had in her tax training, and this is a snapshot of that chart. And if you look at this, these HOH as head of household, you can see that when he had $5,000 of income, he's right here. The green line is the amount that you get back. And head of household at 16,000 is up here in the flat spot, much, much higher. So you know that having the higher earned income is going to get him more of an earned income tax credit. But you can also just make the entries and see where it comes out. So as I said, you go into personal information in the basic information section. And it's really funny. It's in the drop-down menu. And this is just a snapshot of the drop-down menu. There's a lot more above this. So you have to make sure you scroll down, and you have to check the box that the taxpayer wishes to elect to use their 2019 earned income to figure their 2020 earned income credit and or child credit. This COVID-19 is pre-entered in TaxSlayer. You don't even have to make an entry. And then these words are very, very funny, but I have confirmed with TaxSlayer that these are the words. So it says, was your main home or your spouse's main home located in a federally declared disaster area? Well, the whole country was a disaster area. The whole world was. So you enter the earned income from 2019. Now this, if you're not sure what the earned income is, you should go to the Form 8812 line 6A and get the earned income off of there. I wouldn't try to get it off the 1040. I'd go to the actual form. Get that earned income.
If they did earned income last year, right? So that's where
Right,
we would look.
if they had the earned income tax credit. And of course, this is going to require that they bring in their 2019 tax return. We can't just, Lee, on this one, we got to have the return.
And if they don't have it, we should just check. We might have it in our tax layer.
We might have it. We might have it. That's correct. Okay, then, so based on his 2019 earned income of $16,000, he got a much, much higher earned income tax credit. And if you look on the left side, before I did this, it was $1,875 less. So it's worth a lot in this particular example. Now, I did test this by adding $10,000 of unemployment compensation, and it had no effect on the earned income tax credit. So I find it very interesting that they are providing this to people that are in this income category. Someone needs to mute. Someone needs to mute. Or Patrick, you can find them as the host. And it had no effect on the earned income credit. Now, the next one is the avoidance of the IRA penalty. This is some wording that is on the IRS website. And it basically, I'm not going to read it all, but it basically says, if you took this out and it was COVID related, you can avoid the penalty. So to avoid the penalty, you have to, of course, the 1099-R will have a code 1 for early withdrawal. And if you enter a code 1, taxslayer will take you to this page. You have to just follow it. I didn't make snapshots of all the pages, but you want to score that, the distribution penalty was from a retirement plan. And then you want to put a check mark here that there were certain circumstances that will allow you to avoid the penalty. And when you do that, it'll take you to Form 5329, tax on early withdrawal. You can type it up in here and it'll take you right to it. Type in 5329. And when there's a drop-down menu, and the very last item on the drop-down menu is other. And I contacted taxslayer to say, well, why didn't they put COVID-19 related? And they said, well, they didn't, but their other is what you should enter in there. He said maybe by the 12th of February, they might have, something that says COVID-19 related, but you're just supposed to put other.
That 5,000 will already be entered because of the 1099-R?
Yes, you've already entered that. You did that as part of your 1099.
Right. So it'll be carried over to there.
Right. That's
Okay.
right. Okay, then when all this is done correctly, Joe's refund will increase by $1,100 for the recovery rebate credit adjustments. It'll be increased by $1,875 for the EITC look back, and he will have avoided $500 for the IRA early distribution penalty. So these can be big. So that's why we wanted to just make sure you're aware of them and make sure you got to address them. If you get stuck, call one of us and we'll help you with it.
Bob, can I go back to the EIT look back?
Yep.
EITC look back. On the intake form, I guess if you have someone who has unemployment and a little bit of earned income, the W-2, then you would be able to ask the question. But a lot of people received salary decreases last year. And so is this somewhere on the intake form that asks them, is your earned income or maybe it's worded differently, is your employee income less than 2019? Or are we supposed to be asking them that?
Well, earned income can be tricky. And what I suggest you do is you go to that Form 8812 and just do the comparison. Just enter, if you got to have the 2019 return and just see if it went down from 2020. Doesn't matter how it went down, just did it go down?
Okay, so we're supposed to be asking them about their 2019 tax information.
Well, yeah. If
Okay.
they're eligible for the earned income tax credit and child credit. Yeah.
If they were not eligible last year, but they might be this year, can they still use 2019?
Geez, Lee. Anybody want to help me with that one?
Oh, in your example, the 2019 is as is. You can't go in and throw in 2020 numbers. Does that make sense? So if you didn't have it in 2019, how would you get to use the 2019 if you got it in 2020?
I would think that you could, Lee, because what are the reasons why he didn't get it in 2008? He didn't have any earned income. So obviously he's not going to get, that's not going to help him. Or maybe he had too much income. Well, that's not going to help him either. So I
right.
think the
He
answer
has
is
yeah.
I guess the issue is that this is something you might not automatically pick up unless you ask, and it's probably not going to be in the comments section when you first start, or a preparer or anything like that.
right. Yeah, we're going to have to ask. It's unfortunately, we're talking about a lot of potential money for the client. It's very important that we have the discussion. It's very important. I think we've alerted our intake people, for this situation to make sure that they, provide the prior year tax return if it's relevant. So,
If your
Bob.
if your filing status changes, you can't use you're just going to use last year's earned income regardless of their filing status last year.
this
If
filing
this year's
status changed from single to head of household.
if it changed to head of household this year, last year's earned income might get you better even, right? Better than that. But you're not using last year's tax filing status of head of household. Now you're single. It's this year's tax filing, but it's either of the earned incomes, whichever is better.
Okay.
But the intake folks need to be aware of this so we can lend a hand.
That's what I just said. You guys have to.
Got it.
I thought you were, but maybe not. You guys have to be looking for this. And we need that 2019 return. Now, we asked for the prior year return anyway as part of the intake.
Right.
But, many times people don't bring it in.
Of course, sure.
One thing we did was in the mailed document that's getting sent to all of our Scan and Go partners, we included a specific note that says, if you claim the earned income tax credit, we need your 2019 return this year. If we prepared it last year, we're good. So basically along those lines. And then with our virtual upload, we can check and make sure that it has something that states very clearly that it's going to be extra important this year. Yeah, so hopefully we can collect more of those.
And this PowerPoint will be available to you from Emma and the staff. Maybe it's already on the site. I don't know.
Emma,
Okay.
let's just be sure though the intake folks are aware of this so that we don't just gloss over it and not do it. Bob,
Well, you're Mr. Intake, so make sure you're aware.
not to worry.
Yep. I think it's
Frankly-
worthwhile. I think it's worthwhile for the preparers to be asking some of this too. Intake may not catch it. We may not catch it, but the more, if we can ask some probing questions, like, did you take a big income hit? Did you have your income last year? There's some soft questions you can ask. But if they miss it in intake, we should try to ask as well in preparation.
Okay. Martha, you want to talk about capital gains and losses?
Sure. Was Emma going to talk about e-file tags and?
Oh, I'm sorry, e-file tags are on there. Emma, you want to cover e-file tags? Thank you.
Okay.
Yeah, and I'm not going to bring up slides for this because I actually haven't changed it in TaxSlayer yet, but we just wanted to let you know. So historically in TaxSlayer, we've had 3 tags that we use that are kind of like on that main screen. There's scan and go return. What was the other one? Needs additional documents. And then we added a 3rd one last year for signature appointments scheduled when we were doing the virtual. Because of Zendesk, we don't really see a need for all 3 of those. So we're just reducing it down to needs additional documents. And that's super helpful for us as a staff because we will run a weekly audit of TaxSlayer to see like what's going on with all the returns. And if there's one that's been sitting there for 2 weeks, but we can see it's marked that it needs additional documents, we know why and we know how to proceed. So that's really critical for us. And then the other thing is just that we will keep the same as we did in clinic. There will be buttons at the end of the return for the tax preparer to mark when they finished prep, and then a second button for the QR to click when they have finished doing the quality review. And so I think it is, what is it, complete and approved? Is that right, Bob?
Yeah, there's one that is there that you can't touch. It's, you know, it's a part of TaxSlayer on the e-file page, and that's complete. So once the QR person is really finished with the return and that box is checked complete, the transmitters then know they can transmit.
Yeah.
So that will be
Does
there also, the complete button.
Does everyone know where tags are in TaxSlayer for these 2 things?
Right at the end of the e-file page.
Nicola, no.
Sorry, I do not.
Okay, let me pull mine up then really quick while I talk about the other thing.
Yeah, go ahead.
Yeah.
I was going to say I have one open if you want, but.
Oh, that would also be fine because I have to log in. So if you just want to pull it up
Let
on
me
your
just pull
screen.
it up real, and then I'll do a screen share and show you what it looks like. You want to talk also about putting notes in while I'm pulling it up?
Yeah. So the other thing is, you know, because we have Zendesk to track all of our notes this year, notes pretty much like if there's something that we need to know about a tax return, it for the most part should just be kept in Zendesk because that's where everyone's going to be able to see it most easily. Especially remembering our intake people don't have access to TaxSlayer. And the notes fields are, you know, pretty small anyways. But if there's something important that's relevant from year to year, that's still something that I would really appreciate if you put notes in TaxSlayer for. So if it's something like, you know, we know this person is disabled, they never mark it on their intake sheet, but you might want to check with them. Or, you know, this person had XYZ happen this year and it will affect their tax return next year. So even if they don't bring in documents, being aware of it. So if you're noticing something significant, please still put a note in TaxSlayer for it. Also, if something ends up out of scope, please put notes in TaxSlayer for that so we know why we got rid of the client's return.
So let me, and then Emma, can you talk about the other process things? I think I skipped over those, like the consent pins.
You're throwing me hardballs.
Well, no, I can do it while I can do both.
No, so there's also 2 consents that are signed at the end of the return. So this is the closeout that we did not talk, which we never cover in training, and we really should, and I apologize for that. But once you finish prepping the return, there's a couple more screens where you're putting in the client's bank account information. I would urge you to go through that on at least 1 or 2 practice returns, just so you can see how it's set up as far as like setting, like, is the person e-filing? Are they doing direct debit or are they getting a paper check? But there's also 2 consents at the end for TaxSlayer. And for those, we confirm those during the QR process. So when you're talking to the taxpayer, you're going to say, I need your consent for these 2 things. You kind of explain what they are, and then you enter a PIN for them. What we do for the PIN, it doesn't matter if it's the same from year to year. It can be any 5 numbers, but we as a site to kind of standardize it, will do the number 1 plus the last 4 of their social security number because it's a 5-number long PIN. And you'll need to get one from both the taxpayer and their spouse if it's married filing jointly. So just, you know, remembering when you're doing those QR calls, you should be able to get those from both spouses. And there are, so one of the consents is the global carry forward. It basically is the taxpayer granting their permission for TaxSlayer to hold on to their information for 1 year so that whatever VITA site they go to next year will have their stuff already pre-filled, which like for this year is super great for anybody who wants to do the earned income tax credit look back. You know, for other things where just being able to access their past year's information means they don't have to provide last year's tax return. The other one that's on there is, it's on there because of our relational EFIN. So what that means, this sounds a little confusing, is we have two sites. We have our site and then EMU in traditional years, and those two sites both operate in like a relational manner. It's called like the parent site and the child site, and EMU is our child site, and all the information can be accessed together from our end, which is like a whole thing. And Bob's pulling it up, but basically what it means is just that the information that's on their return is available to see like in our parent site. It's a bunch of jargon.
I have a comment on that.
Yes.
Consent. In the past, the preparer has done the consents, and I think one of the reasons is because if they've done the bank account information or any other information in this section, none of it gets saved unless you get to the end.
Yeah, so the
as well.
preparers will still fill this section out. They usually will but I think they fill it out with a dummy pen, if I'm remembering correctly. I'd have to look at our scanning instructions. But it's still something that because if they're not necessarily calling to review the return of the tax preparer, we don't know for sure if the consent has been given. I don't know if Bob has thoughts on this.
What was the question?
Well, the consent has to be marked in order to get through that e-file
Right.
section.
Right.
Otherwise, you get an error message, and none of the information will get saved in that section. For instance, if there's bank account information in there, that will just be unsaved. If the preparer is doing the bank account, for instance.
So the question is, do the preparers put in the taxpayer's PIN, but then QR still confirms it and actually does the verbal confirmation, or do tax preparers put in like a dummy, just like 5 ones, so that it will save, and then QR people are filling it in?
Well, you know, this is before you file, so I would say you fill it out, you know, with the correct 1 plus the last 4 digits.
Okay.
You know, we don't. You're only
But does
certain
the
people
preparer,
are.
does the
Yeah,
preparer fill it out?
the preparer should do it.
Okay.
No, yeah, have the preparer do it. I think, yeah, Scott's right.
Yeah.
You got to get through the
Absolutely,
screen.
have
so
the
you can pass it.
preparer do it.
Okay. Thanks, guys.
Okay, so getting back to I had to open up one in the actual TaxSlayer, not the practice lab. That's why it took me a little while. This is what we have in there now. I don't think staff has had a chance to fix it. But these two are, I don't think you can change. These stay the same. It's these other tags that we've had. One, you know, if you go back a couple years ago, we had like 7 of these. Well, with Zendesk, our primary tagging location will be within Zendesk. And we don't want to have a lot of crosstalk between the tags in TaxSlayer and Zendesk. So we're probably just going to have this one, as Emma said, this one tag right here. And of course, these two, you know, when the preparer is done, they can check this box.
Why bother?
You don't even have to. But
Please do.
you could if you wanted to, but you don't have to. And
It's
then the
helpful.
quality review person, it's going to be critical that they check this box that it's complete. You can't transmit until this is checked.
And I still want all preparers for the standard procedure to be to mark this as ready for review, just because the weekly reports we pull are from TaxSlayer, not from Zendesk, because we get there's different information available on each end, and so this is just helpful.
It's going to stay that way until the quality review is done then.
Mm-hmm.
Right. So Martha, I don't know what you were going to do, but since I'm in a return, do you want me to go to the anything, or do you want to share your own screen?
Why don't I just share my own screen?
Okay.
And if we need to look at something in TaxSlayer, maybe you could pull it up.
Yep, I got it ready to go if you need it.
Okay. So I have not shared a screen before. This is so exciting. So I just hit share. Does this work?
We can see it, Martha.
Got it.
That's good.
Perfect. Good. Okay. Well, a lot of this will be review because you're all experienced, but there were a couple of questions about reporting transactions, trades in batches, and also the capital loss carryover. So I thought I would just review these really quickly. Line 7 on the 1040, 3 different types of things appear on line 7, get put together on line 7. And those 3 things are, first of all, whatever shows up as a capital gain on your 1099 div, right, which is going to be in box 2A. So that's very easy. You just enter the 1099 div and that will automatically transfer over to line 7. This may be something that's issued separately, or it may be part of a brokerage package that you get that has many pages, and a 1099 div may be part of that. Also, you might get a one of these multi-page brokerage statements for a client. Generally, the 1099 div and the 1099 INT will be packaged in here somewhere. They all look different from one another. On the front page, you'll generally get a summary of the stock sales and other kinds of transactions that will give you important information, but you really need to go to the detailed sheet to see the information that you're going to need to enter in taxslayer. On the detailed sheet, you will see the date of sale. Here are 2 different categories of transactions. This one is short-term, this one is long-term. Date of sale. Quantity is not important, but the proceeds is definitely important. That's how much they got from the sale. This is the basis, the date acquired. And here is how much that equity was worth when it was bought. And that also needs to be entered. The gain or loss is here for your interest, but taxslayer calculates it so you don't have to enter that. You enter this information from the brokerage statement here on the income page. I know you know this. Here's the first item under capital gains and losses, and this is where you go to enter this information. Now this page, it raises some questions. First of all, you have to enter the description of the property. I'm never quite sure what to put in that box. Usually I put if it's the sale of one stock, shares of one stock, I'll write an Apple or a P&G or something like that. If it's a bunch of transactions that you're doing together, you might put in various or type A or short-term transactions or some sort of.
Well, you know, Martha, I have a recommendation there.
What do you, yeah, what do you?
Let's say it's from Merrill Lynch. I would do capital M, capital L, dash ST for short term, and then C for covered if the basis was reported to the IRS.
Okay. Well,
if it was Edward Jones, I'd do EJ. If it was,
okay, so
you know, Charles Schwab, I'd do CS.
Okay, there's not much room to type in there, so that sounds like a good solution.
You can consider using a QSIP number.
Yeah, the 5-character numbers for the mutual fund or the stocks symbol. And you could say 10 SH, which means 10 shares of such and such.
And then, that's a good idea. Yeah, I never know exactly what to put in that box. I actually watched one training slideshow that had just Merrill Lynch, which I didn't think was a description of the property, but that's what that one person did. But I think this is much better. Okay, the date acquired, if either that will be given on the detailed sheet from the brokerage house. If not, if it's, for example, a bunch of transactions that you are bundling together, you can click on alternate option, and then you can choose various long-term or various short-term. So you can bundle them together that way. Dates sold, again, if you know.
And Martha, that's what we want them to do.
Right,
We don't
To bun-
want to have, if there's like, 10
yeah.
dates and they're all short-term covered, and they might even be the same security.
right,
We don't want you to enter 10 things in here.
right, right, right,
It comes up particularly with reinvested dividends in
Right.
in mutual funds.
right, right. So yeah, so bundle and then just pick various short-term or various long-term from, if after you click alternate option, you'll get those choices. Date sold. Now, I just went back and looked at the 4012, and what you're supposed to do if you're bundling transactions is not enter anything on date sold, but go down to the adjustments part and click on reporting multiple transactions on a single row. And then you leave this blank. You don't put in a date. So another practice that I had been following and I'd seen other people do is picking the last date for the last transaction if there are multiple transactions. But according to the 4012, you're just supposed to leave that blank. You can't get various. If you click on alternate option here, you don't get various. You get things like worthless or bankrupt. So those are not the alternate options we're looking for if there were multiple transactions. Then sales price, again, either the sale price for a single stock sold or for a group of them. Cost basis type, and this will just be reported to the IRS or not reported to the IRS. So you don't really need to put that in description of property because you're going to pick either reported to the basis reported or not reported to the IRS down here.
I
And
mean, at this point in time, most of them are reported. You go back 3-4 years ago and a lot of them were not reported, but that's all pretty much cleaned out now.
Martha, where is the adjustment page?
oh, it's on the bottom of this. I just see how it says adjustments down here. It's the same page. It's just you scroll down. It's further down. And then finally, cost. This is the basis. Cost is and basis mean the same thing here. Just how much did the taxpayer pay for the stock when he or she bought it? So
Martha, when you're done, I've got it pulled up so I can show it when you're finished.
okay.
So Martha, could you clarify the description for the multiple stock? We were talking about.
Oh, you mean what you put up here?
Yeah.
You could, well, I don't know, what does everybody do? You've got such good ideas about this. Various long-term, various short-term.
So there are four categories, Ann. There's short-term covered and short-term uncovered.
Right.
What I like to do is just say it's ML for Merrill Lynch - short-term.
Okay.
I use the term covered for reported to the IRS.
Right. Or you could
So
do.
there's really only 4 batches of entries that you'll ever need.
Right. Here is.
Well, you really don't need to indicate shorter, long, or reported or not reported because you're going to check the boxes down there.
Right. Yeah.
So
You should report them separately for A, B, D, and E.
Right.
So you could just say Merrill Lynch multiple or something.
Or you could say, Merrill Lynch box A or Merrill Lynch box B. Right?
Do you have to say box A if you're going to check it down there anyway? Because it's going to come out. It's going to come out on the list in different sections on the Schedule D.
Right. Yeah.
You have to fill something in that field.
You have to just put something in there. I don't think it matters really.
Doesn't matter. Okay.
It doesn't really matter. But you get short or long term based on the dates that you enter, and you get, you have to say whether or not the stock is covered in that drop-down menu. So
Okay,
it's just, you need to put something in that box.
okay, all right, thanks.
Okay,
On a personal return, I just put in stock. It works.
yeah, they never any put in that box.
Okay,
Okay, so capital loss carryover, I don't know that we see this very often, but if the taxpayer had a big loss, they may not have been able to claim the entire loss. There's an annual limit of $3,000. And so if they lost more than that, they carry over the loss they didn't take the year before and can take it in the current year. And it can offset whatever gains that they have. If they did their taxes with us last year, that amount should automatically carry over and we don't need to enter it. But if they didn't, we have to take a look and see what it is. Usually taxpayers that have investment activity are smart enough to know that they have a carryover loss and can tell you that they did, so that you can rely on their helping you with that. But where you put this amount is different. You have to go down to the third line here, other capital gains data, including capital loss carryover, and put it there. And generally it's going to be a long-term loss carryover from 2019. And you enter it in one of these three boxes, depending on whether the account is in the name of one spouse, the other, or is a joint account. And you enter it as a positive number, but it shows up on line 7 of the 1040 as a negative number and offsets whatever other gains they have. Okay, well, that's
I
it.
think also that's going to come in automatically if we did their taxes last year.
Right, it should come in automatically.
Right.
Right. But in the event that they did their taxes somewhere else last year, they'll have to give you that number or give you their return from last year so that you can do this correctly.
I don't think it auto-populates the screen from last year's return, but you should look for it on the return itself.
Right.
So Martha, if you could stop screen share, I'll show Nicola where
Okay.
that code is. So Nicola, remember Martha had a screenshot of this upper area right here. And then down at the bottom, there's a whole bunch of things in this drop-down menu, and the one that she highlighted was right here.
Yes, thank you. Yes.
Okay, all right. Okay, Dennis, you want to talk about K1s? Dennis, I think you're muted.
Yep, there I am. Okay.
Yep.
Make sure.
Go ahead.
Hang on.
Yep, we can hear you now.
Okay. K1. Doesn't happen often. Bob thinks maybe 8 to 10 last year or so, something like that.
Yep.
It's typically related to an inheritance from an estate or trust, which is a 1041. So there is an inheritance flowing through an estate, or maybe it's been set up in a testamentary trust or whatever. But the point is the K1 is reporting how much the beneficiary needs to report in terms of income, and the K1 tells them that. Okay. One thing to check right away is, just in case they bring papers in that have a K1 for a non-taxable account like an IRA or 401k, just ignore it. It's not a taxable event, doesn't matter. Okay, so ignore that. I forgot to put something else on the screen. Maybe it's in here now. The 1099K is not a K1. Okay, 1099K is credit card receipt. So don't think when you see a 1099K, don't think it's a K1. Okay, it's a K1 is a very different kind of a form. You'll know it. You'll know it when you see it. It's very different. Let me just show the. Let me just jump over and show the screen itself. Okay, so you want to look at page D48. Okay, I had. Oops. I have to share separate screens. I have to change screens when I change the window, don't I?
Yep.
It's all right. This is really.
Yeah, you got to stop that screen share and start another
Yep,
one.
yep, okay. And share, okay. So here's the a K1 from an estate. These are the ones we might see. Now, you want to look at 4012. This is from the 4012, page D48, okay? And I can't make this screen bigger for some reason, but okay, there you go. A lot of the things on a K1 are out of scope. Very often you won't have this coming for a client anyway, but the important ones are right here at the top. Interest income, ordinary dividends, things like this. These are in scope, right? And the other things that are in scope are down here, foreign taxes and tax exempt interest. Notice all the and there's also short and long-term capital gains, which you may or losses, which you may see sometimes when they close out the estate. The important thing is that only do the K1 if the K1 doesn't have any out of scope. If it has any out of scope, you got to kick it out. The whole return has to be referred to a preparer, I believe. So you're only going to be entering the things that are in scope, and you're not going to enter anything for a K. You're not going to do the K1 if any of the items here that are marked out of scope are on the page. Okay. For foreign tax,
Dennis, isn't it more than that? We're not going to do the return.
That's what I mean. It's, yeah, the return is out of scope, and they have to be referred to the tax.
So Bob Buchanan, to the extent that our intake people, when they
True,
see a
yeah.
K1, if they see it's out of scope, I mean, the last thing we want to have is a preparer spend some time preparing the return, and then they find out that the return is out of scope when they get to the K1. Go right to the K1. If it's out of scope, we tell the client we can't do your return.
And the client, the client's less frustrated too. So that means, I didn't think about that. Now we have intake people this year, so they actually should probably have page D48 around, or refer to the 4012, and make sure that nothing's out of scope. Okay, and is it on the 314 intake form, a K1? Are K1s indicated on 314?
I don't know.
Yeah, I'll take a quick look.
Okay, why do you do that? Because that's another place.
Up here.
That would help. That would help the intake people, rather than looking through all the documents. That would help the intake people flag. I better check to see if the K1 puts it out of scope. Okay. I'll continue to talk while you work on that, Bob.
Yep.
Okay.
I'm looking right now.
Okay. The other kinds of K1s you get, I don't expect you'll get any of them. Frankly, they come from other kinds of entities, like a partnership or a limited liability partnership. Again, a lot of the things that are in scope here, you'll see, are just the interest dividends, qualified dividends, etc. Royalties is also in scope. I doubt we'll ever have one, but if we do, and it comes from a partnership, I doubt we're going to get somebody from a partnership getting royalties. If we do, royalties is in scope, which is kind of confusing, but it's out of scope if there's any expenses associated with it. If in doubt on the royalties thing, ask some others to review it. Ask the quality reviewer to make sure that it's okay. But I don't think you're going to get this, and I don't think you're going to get the other kind of K1, which is from an S corporation, where they're passing through income from an S corp. Okay, so you will see this form coming typically from a trust or an estate, because related to an inheritance or an outright trust. Okay, last point on this: foreign taxes. There's no place to enter that on taxslayer, so you have to actually go into deductions, credits, foreign taxes paid, and enter this foreign taxes paid amount in the credit there, so that that actually that's a credit that offsets their taxes. So it's very important to pick that up. But there's no place in TaxSlayer to put this. So the key message is follow the 4012 pages, okay, for the directions. This page particularly, and make sure we don't do an out of scope return, but enter these things if it is in scope, and that's all they have. Enter the stuff that is in scope up here, right? All these boxes here, these two, this one really doesn't matter much, and foreign taxes just goes on a separate entry. Okay. Hang on while I stop.
All right. So Dennis, let me. I'm going to just share quickly. It is on that.
Go.
It is on that. It's on line 15. Right here, you can see other income, and you will see K1 right there. Can people see that?
Mm-hmm.
Right.
Okay. So Bob Buchanan, it is one of the things that we need to be looking for. You know, the sooner we stop such a return, the more time, the less time we'll
Yep.
waste, and the client's time.
You're not going to see very many. If it's 8
Not
to
very
10
many.
and one or two of them slip through, okay, but you
Right.
know, if you see it, it's a little bit of a flag, okay?
And I have a little like situations to be mindful of thing in the intake guide that I'm finishing up, so I will add K1s to that. I think the other thing it includes is like, I don't remember, it's one of the other forms we talked about that's often out of scope.
Okay, I think I got all that.
Handful of things that are,
Okay, Dennis, you're gonna do HSAs for us?
Yep, I'm going to jump over to that now. Too many screen changes.
Yeah, the screen changes are always fun.
There we go. Okay. So just everybody should have, even those who didn't qualify last year for HSA, this year you should be qualified for HSA as part of the advanced. It's all bundled in. Just let me give a quick overview and give you some updates about new things, especially about qualified medical expenses this year. Okay. So again, the 4012 has a lot of information that helps you navigate these pages and discuss which options are which, et cetera. So it's a pretty good tool for you. If you're not yet familiar with doing HSAs, I would recommend you refer to this. This is on the 4012 page E7, and this has to do with contributions. Okay, you can see a few things are out of scope, but the three most important things is, well, the taxpayer and spouse, they can actually both have HSAs. Typically it's just one, so make sure you click taxpayer or spouse who has the HSA, whether it's single or family coverage. Okay, and if two of them have family coverage, this box will light up, and you should check that if that's the case. Okay, but that's an exceptional thing, so don't worry too much about that. The key things are: enter the contributions from the, what is it, the 54. Why can't I advance the page? I can't advance this page.
There you go.
There you go. From the 5498, okay, that the contributions from the 5498, right, go into this box here. You typically put in 12 months because they were in the plan for 12 months. I'll talk about exceptions to that in a second. And you do not need to put anything in this box down here for employer contributions. However, it's imperative that you do the W-2. On the W-2, there is a code W in box 12 that means employer contributions to an HSA. That includes, employer contributions also includes employee contributions through a cafeteria plan. Okay, so that's all on the W-2. So all you have to do is make sure you get the W-2, the box 12, okay, the box 12, and that'll automatically flow through, okay, down here. Okay, now a couple other things. If they don't bring the SA, the instructions say that the taxpayer records are okay. They can tell you what they contributed. Really, most of them come in with the 5498 SA, and that's what they contributed during the year. Now, I believe that they have the opportunity to do contributions for 2020 contributions. They can make contributions, late contributions, until the due date of this year's of the return. So between January 1 and April 15, you can be putting more in. And they may actually do it, maybe actually put more in by that point because maybe they get a refund and put more in. But you can put in late contributions in addition to SA. You can include it in that entry on that first box. Okay. And all of this is what they call post-tax money, right? It's the basis for the adjustment that's going to reduce gross income. So it's an adjustment to gross income. That's how the HSA credit is taken out. Okay. FYI, here are this year's limits about how much contribution can be put in. Okay, 3550 self, 7100. Again, if there's an excess contributions, they have till 4/15 to take it out without penalty. I put that in red because if that happens, you might alert the customer that the client that they can pull it back out without penalty. They have to pull it back out, including the interest, and that interest is taxable. But that's a 2021 issue. Okay. Other things I think everybody knows is an extra if you're 55 over the limit goes up by $1,000. I'm not going to talk about this in the interest of time, but if you have a situation where there are separate HSAs and each has their own policy. You have to split the 7,100 max, and you have to do the 8889. Again, you have to follow the notes down here, over here about calculating, using the worksheet to calculate 8889. Okay, it's a little confusing. It doesn't happen very often. I'd say just treat that as the exception and just be really careful when you see it happen. Okay, but key is make sure you get the W-2 that is carried over automatically. And what happens is this limit applies to both contributions made by the employee outright plus employer contributions have to be underneath these limits. Okay, so that's the purpose of the employer contribution coming in here. But the employer contribution and the employee's contributions to a cafeteria plan are already out of income, so it's not going to adjust income. So that's why the W-2 is very important to put in there because of the limits. Okay. On the second page, D49, page E8. Okay. Okay, you're going to put in distributions received, qualified medical expenses. Exception here. This kicks it out. I think this becomes out of scope if. Never mind. That's something else. Exception, not very common. HSA, if they get a distribution, for example, if the HSA participant dies or becomes disabled or turns 65, they can actually take all of it out. They can take as much out as they want. It doesn't have to be qualified medical expenses. There's an exception for that, so they don't get a 20% tax on non-qualified distributions. Okay. And again, just a reminder, don't worry about this box down here because it's already coming from the W-2 unless there's some exceptional thing that happens. So qualified medical expenses, same as last year. The Pub 969 hasn't come out yet, but the 502 does have most of the medical expenses that can be claimed. In the CARES Act, it expanded the definition of qualified medical expenses for HSAs. Okay, so here's a list. These will be posted, I think, on the VITA resources. So if you need to see this list, so non-prescription drugs and medications came into the mix, and so did mental care products. So these kinds of things now qualify as legitimate medical expense, qualified medical expenses for the HSA. So if they pull money out, they should save receipts, but they're supposed to save receipts. But these kinds of things are now qualified medical expenses. These things continue to be non-qualified, and therefore, to the extent that they take money out, if this distribution, you have to fill this field in. If this distribution is less than the distribution they took out, it's going to be 20% tax, that difference. Okay. I think that covers it. What I had to say. I know there's a lot of other stuff in here. We'll put these out there so you can review them in more detail. But key is look at the 4012. If you're not really familiar with these screens, it gives you a lot of information, especially about exceptional things. Okay. Questions?
I got a quick question about so the 20% tax on the non-qualified, those non-qualified distributions aren't going to be in their income, right? Because they've already been taken out on the W-2.
Well, the income effect is its contributions. Okay.
I'm
sorry. Let me take that back. If they take out non-qualified distributions, they have a 20% penalty. And does the non-qualified distribution income, Bob? I think it is.
The non-qualified distributions, 20% of that would go as an added tax.
It doesn't go into income though, does it?
No, because
okay, yeah,
the reason the policy is that way is they got a break in the first place by avoiding at some marginal tax rate, and probably for most people it's less than 20%. It's 12 or whatever. But when they don't spend it in the right way, they take it back at 20%, which is, it's not a full 20% penalty because they got about a 10 to 20% savings in the first place.
Yeah, okay. I thought it went back in income. Don't worry about it. It's gonna happen, and the tax layers will do it right.
Any other questions on that?
Yeah, I have a question. Is it written down anywhere whether the coverage is self-only or family, or just the taxpayer has to know this?
I think I don't know if
it's on the form.
I don't know if the I don't know if the 5498 indicates that or not. I think they have to, I think they will know that.
Well, I had a client once who had a HSA but didn't know, and it wasn't an issue because they hadn't made huge contributions, so
Yeah.
they were under the limit for the self-only coverage.
Well, it's
but-
gonna, it depends on their high deductible plan, whether that's family coverage or not.
Usually, if your health insurance is for a family, the HSA just carries forward that way, even though it doesn't say it on the 5498. So if they're paying for children, then it would be a family.
No, you can pay for children even with a self-only coverage.
Yeah.
You can use the money for
Yeah.
anybody in your
household, yeah,
household.
and dependents, yeah.
So it's just on the amount you can contribute to it then.
Right.
But how much,
Right.
right,
It
this
only
is about,
affects them.
this affects the the type of policy, the type of policy, family or single, affects the limits that are placed on it, not the uses of the money. Distributions are different, yeah. But
So
they
the
should know last year when they were in a high deductible health plan, they should know whether it's a single or family coverage.
Okay.
the
Sometimes they
plan.
don't, I found.
It's the plan, right?
Yeah.
If they don't, then I think we have to find out, unless, and Martha, you're right. It's only if they would, if it's only if they are exceeding the self limit
Right.
that it matters.
Right.
Okay, can we move on to the next one? Are there any more
Yeah,
questions?
I'm sorry, I didn't cover that. I got to cover one thing. The box that says how many months are you covered? And this may happen more often this year because of COVID and stuff like that. If they left coverage during the year, for example, they turn 65 and they get Medicare, no longer eligible for HSA, but they've been in for 6 months, the limit is prorated for 6 months. So it's 6/12 of the limit, right? The other thing is, so if they left coverage during the year, you do have to enter less than 12 months for the months that they were in the plan. The complement to that is if they started in a high deductible plan, in a TSA high deductible plan, if they started on or before December 1, they can contribute the full year limit, right? It's called the 12-month rule. They can contribute, and you're supposed to put 12 in the box here, right? Item 2, put in, it says over here, 12-month rule, if they're in, put in they're allowed, they are allowed to put in as much as the full limit, even though they're in only a month or two. Okay.
The question.
Okay, yes.
Eileen has a question.
Just wondering if they haven't used all the amount, and when you bring up the fact that they can now get non-prescription drugs, should we be encouraging them to make sure that they've used all the money? And
no.
I mean, you mean because the definition might go away?
Just in case they don't have, well, let's say they've lost their employment, they're not going to be part of an HSA this year. So if they still have other, expenses that they could claim, should we encourage them to do that, or?
Well, yeah, okay, so that would be in 2021, and frankly, I don't know whether the CARE Act extends this definition of non-prescription things. I don't know if it's a 1 year only or not. Do you know, Bob or Martha?
I have no idea, but I wouldn't be surprised that those more expansive rules will stay.
I think
my
for a
guess,
while, yeah.
but I don't know.
Throughout this year, I
would
don't
be
know.
reluctant to give them any advice on their HSA. Most people that are in them, Eileen, know what they're doing with them. They're used to managing them. They may not be aware, though, of the expansion to these more generic type of items you can get in a pharmacy. So, just make them aware of the expanded definition. Anybody else? Can we move on to the next item?
I have a question. Can you hear me?
Yeah, Lisa, go ahead.
Okay. So when you have a HSA and just that quick, my phone keeps dinging and I lost my question. It was about the limit. I don't know. I'll take a look and then I'll see if I remember.
just come back when you remember.
Yeah, we can loop
That's
back.
fine. Yeah.
Yeah, I'll do that.
Okay,
Thank you.
let's move on to can't pay situations.
Okay.
Now, a bit before Martha starts, so the sooner you find out about a can't pay situation, the better in this case as well. Go ahead, Martha.
Okay. Don't have too much to say about this. First of all, if we're doing their return in February, they have some time before April 15th to pay. So even if they can't pay in February, we always hope that they'll be able to get some money together before the 15th. And if they get their economic impact payment, and if a new one comes out, maybe they can use some of that money to pay what they owe. They can, of course, either use their voucher or a direct debit to schedule a payment for right before the 15th. So that's the best case scenario, is that they will get some money together before the 15th. And this may not be something that we see every year, but we might see a lot more this year because people are probably unaware that their unemployment compensation is taxable. And so if they didn't have any federal withholding, they might wind up owing more than they usually owe. So we have two primary options that we're going to tell them about for making payment arrangements. And one is to contact the U of M Low Income Taxpayer Clinic. And the other is to contact the IRS. There are two numbers that were in the 4012 that I put down here. One, Taxpayer Assistance Center number, and the other is a Taxpayer Advocate Service. Do any of you know which of these deals more directly with can't pay situations? I would think they could try the Assistance Center first, and they may be referred to the Advocate Service, but at any rate, they're two. And I've talked to people who have gotten good, helpful responses from the IRS if they use these phone numbers. And then
the Taxpayer Advocate's Office, we're very lucky. We have one in Detroit.
Right, right.
So that's very, very good for people in Michigan.
Right. So they can, I don't know if it's best to try one then the other or to go right to the Advocate Service, but that is a very helpful service. Okay, and Patrick made up a macro that we're going to use on Zendesk that the QRs will use to kind of summarize these options for people who can't pay. And he just emailed it to me. And this is what he has. He's got the two options at the bottom, the U of M clinic, and then a link to the setting up a payment plan with the IRS. We might also on this macro put those phone numbers, IRS phone numbers down.
That's a good idea. And just so you know, the text, that like wall of text is straight from the Pub 4012 about
right.
Situations.
This is a lot of information, and maybe they can, for them to plow through this stuff from the 4012 about the 120 days and the offer and compromise might be too much information for someone who's kind of in shock that they owe money anyway, so maybe something simpler would be less threatening and more helpful. But that's basically it. Does anyone have any other ideas about this? Okay, should I just keep going on to the next
Yeah, I think so, Martha.
topic? Okay.
Well, the next my HSA question now. Thank you. I remember.
Yeah, go ahead. Go ahead, Lisa.
On an HSA, I know once you start taking Medicaid, you can no longer contribute to an HSA. But if you are still working at age 65 and you have your employer's medical insurance, can you still contribute?
Yes, you can. You're not primary on Medicare yet.
Okay, thank you.
Okay. Moving on, the next one I had was Medicaid waivers. This is something we're not going to see often, but if we only see it once or twice, we can save those particular taxpayers hundreds of dollars if we know about this. So it's important to know about this. And this comes up if a taxpayer is taking care of somebody who's incapacitated and they both live under the same roof. That's very important. So the caregiver and the incapacitated person have to both be living in the same house, whether it's the patient's house or the taxpayer's house. It doesn't matter which one. Oops. So if someone is taking care of their mother-in-law who's incapacitated but goes home at night, they cannot take advantage of this situation, which I'm about to describe. What is tricky about it is that people who are caretakers are getting, in this instance, money from the state that would be paid to a nursing home to take care of this person. And so they're getting Medicaid money directly. It's a good deal for everybody. The caretaker gets money. It's less expensive for the Medicaid program. So it's a good deal all around, but it will not say on the W-2 that this is Medicaid income or Medicaid, in lieu of Medicaid. So it's important to ask the taxpayer if they are working as a caretaker like this, because this income does not need to be taxed. It may be taxed, that's an option. I don't know why anyone would choose it, but it may be taxed, but it doesn't have to be taxed. But nonetheless, it can count as earned income for the earned income tax credit. So it can give them a real break without them having to pay tax on the money. So here is an example of a W-2, just a regular looking W-2, but notice that it's coming from the State Department of Health and Social Services. I don't know what it will look like. This is from a exercise. I don't know what it's going to look like from the state of Michigan, but something comparable. But it will not say on the W-2 that the wages in box 1 are really in lieu of Medicaid. What you do is you enter the W-2 amounts as you would on any W-2, but notice you may carry this number from box 1 down to the Medicaid waiver payment box that's near the bottom page of the page on the right side. If you want to opt to not pay taxes on that amount. Then if you do though want it to count toward the calculation of earned income, you have to check this box right here as well. Usually that's the best situation to do it, to opt out of paying taxes, but to opt into having it calculated as part of earned income. What happens, let's see, here is you'll see the amount on, it'll still show up on line 1 of the 1040, but it will show up as a negative number on other income. It'll show up as a negative amount, which will cancel it out. You'll see in this particular hypothetical case, it wouldn't have mattered if this person elected to not be taxed on that amount, because even with that $9,312, they would have been under the standard deduction. But often this is very helpful. Just it happens not to be, happens not to matter in this particular case. Okay, so the effects of making these optional choices, for this particular exercise, I ran it all 3 ways, with choosing the income tax waiver and counting it as earned income is the best situation for this taxpayer. AGI of $850, federal refund 1207, state refund 205. If she had elected not to have this amount taxed, but and also had elected not to have it count toward earned income, notice that the federal refund goes way down because there's no earned income tax credit. Here, if you miss it, if you just do the default. You assume that the W-2 is a regular W-2 and you miss the fact that this is a caretaker situation who's getting Medicaid money. You see how much worse off. It's around $300 less. The income HEI is higher. The earned income applies obviously because it's now part of taxable income. But look at the state balance due, which is a dramatic difference from what we would have had before, and that's because the AGI is higher. That carries over to the state. Okay, I think that's that. Any questions about?
So you know, when the W-2 comes in, how do you know that there's a Medicaid waiver involved? Do they just
You have to
pay
ask.
that?
You have to
It's
ask.
not, there's no code anywhere, is there? That's
Nope.
the key.
Nope.
Yeah.
It just looks like a regular W-2. That's the
Right.
tricky thing. You have to talk with the person, like what kind of work did you do for this money?
So
And if you-
is an indicator though the source of the W-2, as you said?
Yeah.
Like, yeah, okay.
That's suggestive.
Yeah.
The employer's name is suggestive.
Yeah, I mean, were you employed there? No.
Yeah.
And it'll say MDHHS, right?
Yeah, we just don't know how much of this we're gonna see, but you know, we just want to make everybody aware of it, the intake people aware of it, you know?
Right.
Um,
Yeah, if you
You
know.
don't want to miss it because as Martha said, it can be, you know, it can make a pretty big difference.
Yeah, it could be several $100s. So yeah, it's just
And if
good.
they're, and if they're in a home caring, if they're caring for a person or a relative, especially in their own home, then they're gonna likely be head of household credit, and it bumps them up on the chart pretty good for earned income credit.
Right.
Martha,
Okay.
thank you for bringing this to our attention. Is this new, or has this always existed and we just didn't specifically train on? Because this is wonderful.
Yeah, it's great. It really, it kind of helps everybody. I think it helps them. It helps the Medicaid system too, because it's less expensive for them. It's great for the caregiver. No, it was in place last year, I know. So, okay. Anything else or?
Yeah, we can go on to the next one if there's no more questions. And this next one is very important. This is I think a fairly significant enhancement to our efficiently doing the homestead property tax credit for Michigan. So Dennis, Martha, if you'd stop sharing your screen so that Dennis can put his.
Okay. I had the taxable amount not determined in the simplified method, but I can do that after.
Oh.
Go ahead, Martha.
Should I
Yes,
just
we skipped over that, didn't we? Yeah, go
Yeah.
ahead.
Go ahead, please.
Yeah.
Okay. This is going to be review for most people, but to get to the simplified method, I have to kind of review a couple of things first. And this is how to calculate the taxable amount of a pension or annuity when it has not been calculated, when that's up to you as the preparer. First of all, there are a couple cases that are not difficult. So here's the first. If the taxable amount is given on the 1099-R and it is less than the gross distribution, look down to box 5. This is usually an annuity where you know, sort of going into the contract, how much of your distribution is going to be taxed every year. And how much is not going to be taxed because it's part of your contribution. So if you add what's in box 2A and in what's in box 5 and you come up with the gross distribution, then you know that the taxable amount has been figured correctly and you just enter that and you're done. So notice that the taxable amount not determined box is not checked because it has been determined. So that's an easy case. Also, IRAs are usually very simple and straightforward, even though the taxable amount not determined box is checked. And in these cases, usually the taxable amount is indeed exactly equivalent to the gross distribution. And this is the box is checked, I've been told, only because IRA custodians don't know who owned the IRA before they did. And so it could be the case that some of the money in the IRA was made with after-tax money. In other words, non-deductible amounts by the taxpayer. If that's the case, the taxpayer will know this and they can tell you, yes, some of the money in my IRA was made with after-tax money, contributions that I made. And they will have to tell you that, and then you adjust the taxable amount downward. But that's not usually the case. Usually the taxable amount is the same as the gross distribution. So that IRAs are generally pretty easy too. This is the
But,
situation.
but Martha, in that case, let's say the taxpayer said I did make after-tax contributions and they know the amount.
Uh-huh.
You go to the simplified method page, or what do you do?
No, you just subtract that amount from the taxable amount.
Well, but you don't do that every year. If they made, X amount of after-tax contributions in their 25-year career at the Rawsonville plant at Ford Motor Company or something like that, don't you divide that by the years that the, whether it's a period certain or you don't take away the whole amount that they contributed as after-tax contributions.
Okay.
You have to divide that by a number of years.
Okay.
Yeah. Right?
Well, if they making these are IRAs. They should
Yes.
have an IRA statement that shows what their contributions are. You would subtract the contributions for the year, not.
Well, this is if
right,
you made a taxable contribution up in the early years. When you go to take it out, a portion of that is not taxable. But if you're taking it out as distributions, then you only get a portion of what you put in that was
Right.
originally
Each year.
taxed.
Each year you do. Yeah, and they
I
actually
have
like
to,
yeah.
I have to admit, I've never had a taxpayer tell me part of my contribution was made with after-tax money.
Yeah, I don't think we're going to see it with our client base.
It's super rare.
I think so too. I think so too. I actually thought it threw it out of scope, but I don't know.
It
Maybe
actually is more normal that you would see it with an annuity, not with an IRA.
Right.
Right.
And a pension. Yeah. Right.
Yep. Go ahead, Martha. I think
Anyway,
it's,
okay.
yeah.
This is the usual kind of situation where you have to use the simplified method. And that's where there's nothing in the taxable amount box. And you see in box 9B down here, total employee contributions, the situation you were describing, where they have paid into this plan over the years and they have, you have to calculate the taxable amount over the span of the number of years that since they originally started taking distributions. There may be notes in taxslayer carried forward to help you with filling in the different aspects of the simplified method worksheet that you're going to need to fill out. So you might look for that first. And at the end of the process, after you know all those figures, you should put that in taxslayer to carry over to 2021. That would be very helpful. Okay, so this is the situation. You have to calculate the taxable amount, and there are two different things you can do. You can use the simplified worksheet that you get with taxslayer. You click, do you need to calculate your taxable amount? Click here for options. You click through a couple of screens and you get to, and this is from the 4012, you get to this, this screen. The 4012 explains what you need to enter in each box. The plan cost, that is the employee contributions figure that shows up in box 9B, you enter there. Starting date of annuity, you have to get this from the taxpayer. You won't, this doesn't appear on any document. So they have to tell you when they started taking distributions from the pension. And that's very important. Usually nothing is needed. Oh, check if this is a joint or survivor annuity. That's important because then you have to enter information, the age of your spouse as well. You add the ages of the, you put your age at the start date, at this date here, and if it's a joint or survivor annuity, you have to add the ages of the recipients, number of months paid in 2020, amounts previously recovered. This is something that is hard to calculate unless you have this particular annuity calculator, excuse me, which I use all the time, which does two important things that is hard to do using the taxslayer worksheet alone. First of all, adding the age of the taxpayer and the spouse to get the right result is trickier than it sounds, because you have to add their ages at the start date of the annuity, not at the end of the year. And so you have to be sensitive to whether, if they started taking in August and their birthday was in April. At any rate, it's kind of a headache to come up with this number. Also, this number is not easy to come up with either. So what I would recommend is that you use this particular annuity calculator to come up with these numbers. There's a video tour you can take that will walk you through it very slowly, which I won't do right now. But what's so nice is that you put in the annuity start date, you put in let's say this is a joint or survivor annuity, you put in the annuitant's birth date, the spouse's birth date, and the calculator works out how old they were at this date, 1st of December 2018. This is the number 103 that you would need to enter in the taxslayer worksheet, but is sometimes easy to get wrong, but it's impossible to get wrong with this calculator. Gross distribution for the year, total, that's box 1, and total annuity contributions, that's box 9B. And then all you have to do is click here to calculate, and you come up with the taxable amount for the year. You come up with the amounts previously recovered. This 1251 down here is that number that you're supposed to put in this last box on the taxslayer page, and it's just all very easy. And another nice thing about this calculator is that you can click one of these two boxes if appropriate, and you'll get different options. Public safety officer pensions frequently have medical insurance built in that you can subtract from the taxable portion of the distribution, up to $3,000. So it's important to know if it's a pension for a law enforcement person who's a retired law enforcement person. And then disability pensions, this is very important because up until the normal retirement age, disability pensions are treated as wages. And so they get reported on line 1 of the 1040, and you don't have a, it's entirely different. So this is important to know too. And anyway, I highly recommend this tool.
This belongs in the Hall of Fame with a qualified dependent calculator, huh?
Yeah.
Wow.
From the same organization.
Yes, it's this Bogart is this guy in Colorado.
Oh, Colorado, yeah.
Yeah, co-tax aid, that's Colorado tax aid.
Yeah,
and his tools are just wonderfully helpful.
You gotta get him to move to Washington County.
Yeah.
Okay, great. Any questions of Martha? Thanks, Martha.
Okay.
What you guys should, I mean, if you're not following all this, you know who to call when you're doing a return and you're not sure. So now we're going to go, I believe, to the homestead property tax credit housing list. Dennis?
Good. Okay, so everybody but John probably remembers our famous 2017 housing list, which is the four-page paper copy that we haven't updated in quite a while. And some of you remember last year that we got a hold of some Michigan state listing of houses in the state, housing residence addresses that were, yeah, there you go. They were in, either tax exempt or service fee list. And there were like 51,000 entries in the list. So what we did is we took that, we consolidated it, and I'll show you what we've got in terms of a. Why can't I? Hang on. I can't advance the screen.
Emma, will you let my computer in, please? In the meeting.
I think Emma stepped away for just a moment.
Oh, okay.
And they're the only one who can do so. Let me send them a direct message. And
okay, thank you.
Hang on. Why can't I? Okay, there we go. Okay, so we're talking about distinguishing service fee from tax exempt housing for the purpose of the property tax credit, Michigan property tax credit. The green form for rentals, when we get the intake, the state intake form is on green for rentals, okay? And you'll see this year that we've modified the bottom for the taxpayers to look up the address in the housing list. Okay, you see it here. It's in on the paper, on the image copy you get of the form. You won't be able to click on this link, but you probably want to have it in your links. It's basically in our Michigan in the VITA tax resources. There's a Michigan tax resources, and you will find this presentation as well as the list in that on that page. So you want to save that link and go to it when you're checking housing. So the scenario is basically you have someone renting property, and the objective is to determine whether it's eligible for a home property tax or ineligible because it's tax exempt. If it's a tax exempt property that pays service fees, then it's eligible for the service fee housing approach, right? Option 3. Or if it's not on this list, then you have to distinguish based on question 3 whether it's subsidized rent or not, in which case you go into either part 3 or part 2 for a full rate commercial property. Follow? That's what the objective is. So what we did was we took the, why can't I change screen? There it is. So we took the state list and we consolidated it into we took their spreadsheet, we consolidated it, enhanced it, standardized it, and made it into a filterable list. Rather than using Control F to do a search, we parsed all the street number, house, et cetera. We indicated what the property tax credit type is, whether it's service fee or tax exempt. We put the rate in. That doesn't matter because taxslayer will automatically calculate it. There's some other information in here. I'm not going to go through this in much detail other than to show you that there's a list. It's on the site. This presentation is in the Michigan Tax Resources at the VITA resource site and at United Way. So look at the presentation and then play around with the spreadsheet, okay? Just to show you what we mean though about how this will work. There's a filtering capability that allows you to rapidly just put in a couple characters and it will narrow down the list dramatically. And there's a whole bunch of stuff in this presentation, like tips about how to use it and how to make sure you don't miss one, etc. But here's a simple example. If you just use the house number, which I find very convenient, the street address itself, the number, right? If you type in the street, it will pull up all kinds of, this list narrows rapidly when you filter on it. And it will tell you then that, oh, here's Armstrong. I'm looking for 610 Armstrong Drive. It's service fee, etc. Here's the land. Maybe we know the landlord, maybe we know the property name, etc. Okay. So it's a very rich list full of lots of information. But the key thing is for you to be able to sift through it on a filtering basis. All right. The list also includes lists of commercial property, a landlord's tab, because we use that paper copy sometimes to just be able to fill out page 3 of the Michigan 1040 CR, where you had to put the landlord or the property manager's address, and address, name and address in. Okay, so look at the slides. Also, we have talked for years about getting copies of all of the co-op letters, and Julia is on the hunt. We've got our first one in, and you will see in the same spreadsheet that we have on the site, the ability to look at, when you look at the landlords, you'll see a section for co-op housing. So if someone comes in, you don't use the big list to determine whether they're in co-op. It's only to distinguish a service fee from tax exempt. They'll know if they're in a co-op. We ask them to bring in the letter. We're asking preparers that when you get a good copy of a letter and don't see that we have one here yet, in our landlord list, just send us an internal note in Zendesk to Julia or me, and we'll grab the letter and we'll put it on the website so that it comes up here in the link like here. So we have Forest Hills already there. If you go to the website, you'll see, and you'll be able, if you click on the letter, you'll see a nice copy of the Forest Hills co-op letter in case the customer comes in without the letter. Okay.
So Bob Buchanan, the intake people might see that letter first. If you can remember just to send it to Julia or Dennis, we can get it uploaded.
Or Bob, it's going to be in the scanned documents anyway. Just send us an internal note alerting Julia or me, and an internal note at Dennis or at Julia. Hey, this one's got a good, just on that ticket. Just, hey, this one's got a good co-op letter we don't have yet. Okay, for the first month, just do that. Routinely, if you get co-op letters, we'd appreciate that. Once it gets populated, we'll tell you not to worry about it anymore. Is that fair enough?
Actually, Patrick, Emma, and I have been having a private conversation through chat, which you can't see. We're working on a to-do list for the intake people, so not to worry, we're on it.
Good.
But
Okay.
you can't see. Okay.
Again, it's on the website. If go to that website, I can get back to it. I can't navigate. Go to the VITA resources
Julia
site.
put a link to the
We'll put a
website, to the United Way website for you to get to it quickly in the
In
chat.
the chat. Thanks.
Yeah.
I can't navigate the PowerPoints. I don't know why. Thank you.
Bob, you're muted.
Bob, you're muted.
I said you'll get used to this thing. The PowerPoint's on the United Way website. After a few tries, you'll really get used to it. It's going to really be helpful.
We also dropped the Excel sheet into Google Sheets, and Julia's work. We're still don't assume that it's going to quite look like that. We're still tweaking it a little bit so it gets filterable the right way. It's not working quite like Excel, but we'll get it sorted out. The idea is basically you just pull the filter down and type in a partial string, either numbers or letters, and it'll start filtering to it, and then you click OK, and it'll pull up just those rows that meet those criteria. Don't overfill.
And one other thing, a full property tax paying place, that's not on there. This is all the other stuff.
If you don't find it on the list, if they're not a co-op, and they'll know if they are, if you don't find it on the list and they're paying rent, all you have to worry about is whether it's subsidized or not, whether you use option 2 or 3. But in either case, the net rent that they pay, whether it's option 2 or 3, it's going to be 23% eligible for property tax.
That is so wonderful. Thank you so much for doing that, and save us a lot of time.
A lot of hard work, but I think it's going to really pay off.
Yeah.
It's also Washington County, and we talked to Laura and some others about expanding to nearby areas. So we'll go into Jackson County and Lenawee a little bit. So it's already got 2,000 entries in it, but most of those are university housing, so they don't matter.
And just so people know, regarding
Question, send me a note.
Just a quick regarding the quick guy, the update for how to filter through Google Sheets will be up today. I finished it and I'm gonna send it to Dennis so we can talk about it after this.
Good.
But it should be done. It'll be up by the end of the day today. If you
Excellent.
are not
Great.
familiar with Google Sheets, we
Great,
got
great,
you.
great. Thank you. I am not. Good.
Okay, Scott, are you ready to talk about city taxes?
Yes, and I'll try to be brief. People are probably interested in lunch pretty soon. I'm going to share my screen. Let's see where I want to go. Okay, I'm into this is about city taxes. I'm into a W-2 statement. I wanted to show you this first in taxslayer. We'll go to edit. At the bottom of your W-2 screen, we scroll down, you'll see, where did I want to go? All the way down. Here we are. After add state, you see a list of cities that what will happen is when you go to put in the city name, you'll want to put in the city name exactly as you see it on this list. The one you might see for Detroit, you might see it on the W-2 as DET, but you want to type in DETROIT, the full name exactly here, and you would put that in line 20 here, local name. So I wanted to show you that first. The situation you're going to get when you do city taxes, there's a couple situations. You might be going to Detroit, or you might be going to one of those other cities. The situation we usually have with our population is probably somebody who's not a resident of the city, but works at a city. And if you were doing anything but Detroit, you would go into this area called localities and start working in that area. They do what's called the common form or the Michigan City form. And so every city except Detroit, and I think Port Huron, uses the common form. And we're not going to spend much time on that. However, I'll point you to a video in a little bit that does discuss that. So at this point, I'm going to back out. And if you were going to do Detroit, you would go into Michigan, edit. Is everybody seeing this okay?
It's kind of fuzzy. I don't know why.
Yeah, it's
Okay.
a little bit fuzzy, but we're getting the idea. It's fine. I think it's okay.
All right. So at the very bottom, you would start your Detroit return at this point right here. Of course, there's going to be three types of returns possible. You're going to have a resident of Detroit. They pay a 2.4% tax. You're going to have a non-resident of Detroit. I think they pay a 1.2% tax on their income in Detroit. And then you have the non-res or the part-time resident. And those are three different forms for Detroit. So I'm going to skip this part of taxslayer, and I'm going to go to a site which I'm having trouble seeing.
You got to unshare this, Scott, to get over. You're going to go to the links.
Yeah, I'm still going to go
into. So stop sharing at the top.
Yeah, I'll stop sharing. Okay.
Yeah, then open up the one that shows those 4 videos.
Yeah. Okay. Here, it's going to be right here. Now I'll go back to Zoom and I'll share screen again.
And while you're doing that, Scott, you know, the situations are resident of Detroit, but not working in Detroit. Resident of Detroit and working in Detroit, and not a resident of Detroit and working in Detroit.
That's true.
Yeah.
Okay. So this site here is a link that Emma actually sent to me. This Community Economic Development Association of Michigan, and then they have the Michigan Economic Impact Coalition, MEIC, and they have a page on city taxes and Michigan tax links. And I don't know if we're going to have this link in our resources, but I would suggest it, or at least link to some of these handouts and PowerPoints. If you go down far enough, you get into Michigan City Tax Training. This first video is like a half hour on all the common form entry situations, pretty long. I was going to go into the City of Detroit set of videos. Hopefully. Here it comes.
That's the one, yeah.
Now, Bob, I wasn't going to show the overview in the interest of time.
Yeah, but the only thing, Scott, that my experience is that do the one on the right side, right? That one first.
I was going to skip over it.
Yeah, you don't have to go through them. I think they're very self-explanatory, and they're quite good, I think. And they're not that long. What are they, like 10 minutes each, Scott, or 7 minutes?
Oh, they're less than that. They're
not long.
5, and this one is a little over 5. This is the one you probably will run into the most common. It has 2 parts to it. The first part is the non-resident who works all the time in Detroit, and that's very straightforward. As just most of the income situations and even some of the subtractions, if necessary, that come from federal and state tax entries, just carry forward into Detroit. And what you basically do is then you would look at the printed form when you print your Michigan return. The Detroit form is going to be at the end, and you would just check to see if all the entries make sense. The second half of the video deals with the situation where you might have a worker he's based in Detroit, he's non-resident, but he works from home some of the time. And it tells you how to allocate the cost such that he doesn't have to pay Detroit city tax on those days where he's working from home or on vacation, and it explains that. So I would say if you want to look at those videos on your own, that would probably be the best thing.
So we're not going to get a lot. That's great, Scott.
How's
We're
that
not going
sound?
to get a lot of city taxes. But when we do, Martha and Scott and John Dillon have had a lot of experience, and several of the rest of us have had some. Don't hesitate to call. If you get a chance to look at these videos, look at them. Any questions?
Oh,
Scott?
I have a question. I just looked up the CDAM website, and I couldn't find those resources. I did get to the.
Well, that last one, Scott, I don't think is on there. I think Julia has to post that one separately.
Oh, I was talking about the CDAM website. The what does it stand for?
Well, I can share my screen again.
Okay, let me share mine here real quick. Go ahead.
Well, let me.
So where is it on the top? You go into CDAM, it has like a list of options, like about programs, training, resources, policy. Where is that?
Yeah, whoops. Yeah, it's not on, you can't get there, I don't think, from any of these menus at the top. All right. I had the link to this particular page from Emma. And so that's the trick.
I just put it in the chat, and I will add it to our Michigan Resources webpage.
Thank you.
Yeah.
Okay. So once you get to this page, you have to scroll down quite a bit till you get to where Michigan City Tax Training is. And there's some other videos from Accounting Aid Society from 2019, although it looks like these are dated 2020 and they're for tax year 2019. And they're a little bit longer. They talk about some more special situations that you might run into. There's a few odds and ends where occasionally something in the Michigan or federal entries doesn't carry into the city's tax calculation through taxslayer, but they're relatively rare cases, and I don't think I'll discuss them right now.
Yeah. Okay.
All right.
Hey, Emma, in the beginning, did you talk about the EIC due diligence and the Michigan use tax, or did we not cover that yet?
Didn't you?
I did not.
Okay, so just two closing things. We do not, you remember the earned income tax credit due diligence that had like 22 questions that used to drive you crazy? We don't have to do it. Okay, it's been confirmed. It's been confirmed by taxslayer, and you know they're going to get the credit. You don't have to do that due diligence sheet. That should help you with your preparation time. On the Michigan use tax, you have to ask the question of the client whether they had any use tax that they have to report. And of course, you know, 99% of the people will not. You don't have to make any entries in Michigan. We're stopping that for efficiency purposes. Just leave it all blank, but do ask the question. And that's it, Emma. I think
Yeah.
I think we've covered everything. I knew it was going to take longer than an hour, but I think
Sorry,
you know,
guys.
a lot of this is fire for effect. You're never going to memorize it all. We've shown you where the resources are, and the beauty of doing the